Now we turn our focus to the rollback of a property tax announcement in India's budget. Pressured by the real estate sector, the government reversed its decision on long-term capital gains tax on the sale of property. And this next report gives you the nuanced changes and what it means and what it could mean to you. Take a look.
India's decision to amend its proposed changes to the long-term capital gains tax regime on property sales follows significant backlash from opposition parties and stakeholders. The opposition says the government lacks foresight and strategic vision. Initially, the country's budget proposed eliminating indexation benefits, meaning homeowners would pay taxes on the full profit from property sales without adjusting for inflation. This move, aimed at increasing revenue, was criticized for adding undue financial stress on the middle class. Faced with mounting pressure from the real estate sector, the government retracted its initial proposal. The new amendment allows taxpayers to choose between a 12.5% tax without indexation and the traditional 20% rate with indexation for properties acquired before July 23, 2024. According to experts, this concession is a clear attempt to mollify critics and avoid alienating a significant voter base. However, it raises important questions about the government's fiscal policy and its approach to taxation. The middle class, often seen as the backbone of the Indian economy, has borne the brunt of various financial pressures in recent years. By initially proposing to remove indexation benefits, the government appeared indifferent to the economic realities faced by millions of taxpayers. Though a relief, underscores the government's reactive rather than proactive policy making. It also brings into question the potential revenues from the original proposal being enforced. Reports suggest a rather meager earning from such a policy. The move also seemed like an attempt at quick revenue generation rather than a well-thought-out fiscal strategy. From a global perspective, the flip-flop reflects poorly on India's policy stability and predictability, crucial factors for attracting foreign investment. Investors seek environments where policies are consistent and not subject to frequent changes driven by backlash. Taxation policies should ideally balance revenue generation with economic growth and taxpayer fairness. The government's initial attempt to scrap indexation benefits could have potentially stifled property market growth and driven more transactions into the informal economy or the black money era, as most Indians remember it. Business Bureau Report, WION, World is One.